Thank you. We're okay.
Perfect. Thank you.
Oh, you're going to use that. Yep. So just use the wee mute button on there to mute it. Excellent. All the best. Yes.
Kia ora, everyone. Thank you for coming. Sun's come out, so I don't have to say on this miserable day like I usually do, so it's nice. As I told you yesterday and last week and on the course outline today, we have a special guest lecturer, and that is John Berry. And he is the co-founder and CEO of Pathfinder Funds. You guys would have seen this IPO already when we were talking about the assignment. John did work as an investment banker and lawyer in London and Sydney before coming back to New Zealand to launch Pathfinder, and he also sits on the Men's Health Board. So without any more from me, pass over to John. Thank you, John, for coming.
Thanks, Sebastian. Kia ora, everyone, and thanks for including me in your course. Awesome to be here. Thanks for putting the sunshine on as well. I'm from Auckland. We don't see much of that these days. What we're going to chat about today is ethical investing and not compromising on returns. And for a lot of people, it's a struggle to actually believe you can make money and do it ethically. We're going to talk through about how we do that. So what we're going to cover today, I'll give you a quick background to Pathfinder and who we are and sort of where we come from. We're going to focus on one of our funds, which is our Ethical Trans-Tasman Fund, and just look at a few stocks inside the fund. And we'll finish up by talking about private assets, which are unlisted stocks. I think they'll become increasingly important for you and your investing and your careers, investing in stocks that are not listed, that are in the private space. So we'll cover a bit of that. So starting off with a bit about Pathfinder. Oh, whoops. Didn't go so well. Here we go. So what we're really clear on as a business is having a mission, and our mission is generating individual wealth and collective well-being through ethical investing. And it's this idea of making money and not only avoiding harm, but actually positively benefiting the planet and people. A lot of people struggle with the idea you can have both. We talk about duality. So we use the lens of always looking at ethics and good returns. And we'll sort of look at how that plays out in terms of making money. You know, how I describe myself, I'm still a capitalist, which some people struggle with the idea. I believe capitalism is a great system for prosperity and for humanity in the future. It just has challenges and issues at the moment. And I'm doing a talk which Sebastian's arranged for tomorrow on different business models and sort of social enterprise kind of capitalism, conscious capitalism. So come along to that if you have interest. But I'm not going to focus so much on business models today, more on how we invest. So I'm going backwards. Okay, here we go. So 3 filters we apply to all our investments are people, planet and animals. We're probably the only manager in New Zealand that does that. I know 2 managers in Australia who do. So we're thinking about ecosystems, we're thinking about communities in the way we invest. Our investment philosophy, if you're going to be a successful investor, you've got to understand what your philosophy is and how you invest, and you've got to be able to break it down to really simple principles. Our first one is high-level decisions are critical. So it's this idea that large liquid markets like large stocks in the US or Europe, those markets are largely efficient. So really hard to do bottom-up stock picking. So the high-level decisions are the macro decisions around what geography do I want to invest in? Do I want to overweight Europe or Japan or the US or emerging markets? What industries do I want to be in? Do I want to be in transport or consumer discretionary or energy? So those sort of high-level decisions around geography and industry, and also market factors within your portfolio. Do I want to be weighted to large caps or small caps? Do I want stocks with a high dividend yield? Those sort of, that framework, those high-level macro decisions are really important. Secondly, integrating ESG, environmental, social and governance metrics. You guys should be all over this. ESG is just data. It's not an answer, a perfect answer to investing, but it is helpful information, helpful data for analysing your portfolio. You must have a human overlay who interprets the data and helps you understand the data and how it's relevant to your portfolio, rather than just taking the data on the face of it. You've got different providers will give you different data and different answers. You've got to understand the methodology, and you've got to understand what is actual data and what has been assumed within the data. Thirdly, research, absolutely critical. And this is around, as an investor, you want to, if you have a success, you want to actually understand, why was I successful in that investment? How can I repeat that in the future? And so researching and data and process and structure is really, really important. And finally, long-term focus. We're not a day trader. We don't trade on a one-week basis or a monthly basis. We're implementing investment decisions typically with a 3 to 7 year horizon. So medium to longer term focus. How we describe ourselves: active and ethical. So we are active in terms of our approach to investing. We're not low-cost passive in terms of just following the market up and down. We're very thoughtful and handpick the stocks we invest in with our ethical overlay. You know, what does ethical investment mean to Pathfinder? I'm not going to spend too much time on this today, but essentially we use 5 levels. Firstly, avoiding harm, so exclusions. In my mind, if your mission is to change the world, just avoiding stuff is not going to change the world in a hurry. So it helps me sleep better at night. Need to do more than just avoiding harm to drive change. Secondly, choosing better companies. ESG is part of that. Choosing companies that are actually positive for the planet. Thirdly, sustainable themes. So we look to overweight things like community finance, community housing, water technology, energy efficiency. So what renewable energy. So things that we see as like macro trends that have long-term tailwinds that are going to make money for investors, but also going to be positive for the planet. Fourthly, stewardship, which is voting as an investor, engaging with companies, advocating more broadly for change. That's important for being an ethical investor. And finally, impact. This is investing in companies generally that are not listed on the stock exchange, private companies that have an important purpose, not just making money, but also a purpose for improving environmental or community outcomes. So we'll look at that a bit later. I'm just going to go through really quickly 3 things about our business that has changed significantly over the last 10 years. Firstly, our size and scale. You know, sort of 10 years ago, we were tiny and struggling to get oxygen. No one really wanted to talk about ethical investing. Now we're part of the Alvarium group. We've got 1.8 billion within Alvarium that we're managing. We've gone from an investment team sort of 5-6 years ago of 2 or 3 people to 7 professionals. We're really, really focused on our frameworks, our ethical framework and our investment framework. And if you look at our SIPO, you'll see we've actually incorporated our ethical principles into our investment framework, which is probably a first for a New Zealand manager. We have an ethics committee and an investment committee. We've combined them together. So the investment team with the investment committee is discussing the ethics of how we're investing as well. And thirdly, really proud of this slide of the awards we've won recently. And it's not just because some of the awards are for our returns as an investor, generating great returns, but also for our business model around social enterprise, and also from Mindful Money for our ethical approach to investing in KiwiSaver. So that's enough about Pathfinder. Let's draw down to one of our funds. Here's Hamish, our star portfolio manager for ethical trans-Tasman equities. He lives and breathes this stuff. The fund that Hamish is running launched in 2019, long only, so we're never short stocks. We're only buying and holding. The time horizon I mentioned earlier, 3 to 7 years, typically, with the framework we're looking at for investing in. Sort of a loose target. If you're going to be an active manager, you want to outperform the market. Our target is we want to be outperforming by 1 to 3%. This is quite busy, this slide, but essentially it's trying to give you an idea of how we filter down our universe. If you look at the top line is how many companies are listed in Australia and New Zealand is about 600. We then take off those that are excluded by our ethics policy. So it may be animal exploitation or gambling or tobacco, stocks, fossil fuels, takes out about 10% of the market. And then from what's left, which is 540 stocks, we're looking to build a portfolio of 10 to 40 stocks and currently hold 24. In that sort of brown or tan coloured triangle, that talks about top-down macro and bottom-up analysis of companies. So we have, we do both those things, and I'll just sort of run you through that really quickly. Sort of from the top down, what we're thinking about with the ethical Trans-Tasman Fund and all our funds is, what are the themes we want to invest in? So first of all, we're focusing on renewable energy, we're focusing on the aging population, we're focusing on water technology, among other themes, but those are 3 examples. What are we not focusing on? Commercial property, wrong part of the cycle for that. Consumer discretionary, again, economy slowing, potential recession. We don't have hot stocks like warehouse in there, and cyclicals, so companies that are really sensitive to the ups and downs of the economy. Mainframe is an example there. So this slide sort of shows the 5 things that the investment team are thinking about on an ongoing basis with every stock held in the portfolio. Sort of starting on the right hand side, financial strength. What we want there is high quality companies. We're not after distressed companies. We want strong balance sheets. We want to know they're not over leveraged with debt. Quality of management, it's the same as anything in life. It's like having a quality lecturer on your course. You'll do better if you've got quality leadership. So we're really focused on management. Valuation, we're looking at valuation metrics for a company, not just in relation to its own history, but also its local and international peers. Business quality, again, what does a quality business look like from a financial perspective? It's about consistent revenue growth, it's about strong margins, and then ESG, and I've got carbon in there as well. Sort of carbon and carbon transition is really important to how we look at companies. Going to look at two stocks in the portfolio that have worked really well for us. And bear in mind, whenever portfolio managers talk to you, they will only talk about the winners. So we're going to talk about one that hasn't worked so well as well, but 2 that have worked. So Hamish was obviously very keen for me to talk about Infratel and QBE. He was less keen for me to talk about scales, but we'll talk about that because I think it's important for you. You learn more often from your stocks that haven't worked well than you do from the ones that have worked well. So Infratel, currently the largest holding in the portfolio, over 8%, and QBE, 3rd largest holding at over 5%. Infratel is essentially an investment company, mostly infrastructure investment. From the ethical side, what we like, heavily invested in renewable energy. It's got data centers, and particularly with the data centers, a lot of technology around water efficiency. If you think of data centers, they're really energy intensive and they use a lot of water in their cooling systems. So we're interested in data centers that are efficient on water use, and have got a health division as well. So we bought into that in 2019 at $4.90, looking pretty good on the current price. So it is the #1 stock in the portfolio. A lot of that, the size in the portfolio will have come just from the stock performing so well. And how does it fit in at the moment with why we're continuing to hold it? It's, we see it as a really good stock in the current environment where there's a lot of uncertainty. You want defensive stocks, really strong balance sheet. So if great opportunities come along for it to add on to its existing divisions, it has the balance sheet and can leverage up to do that. Really good quality long-term management. How do we value it? I'm going to show you a slide of where we, how it's actually valued. I'm going to show you what Forsyth Barr have provided. It's similar to the analysis we've done internally. At the current price of $9.85, we would say it's valued significantly above that. Here's, won't go into detail, but essentially, with an investment company like Infratel, which has different divisions covering health and renewables, you've got to value each of those individual divisions on a discounted cash flow basis and then add up what that means overall. So Forsyth Barr indicating just under $12, we'd say $11.50 to $12 is a pretty good range for it. QBE, insurance company, what we like about it. As an insurance company, what I like when I hear them explain themselves is the understanding around the need for resilience in the future, the challenges that climate change is bringing, and what their role as an insurance company is in that. You think of challenges to food supply, you think of challenges to physical property, through wet parts of the globe getting wetter, dry parts getting drier. Insurance companies have a really important part to play in that. They're also really committed to green bond investment. So if you think of an insurance company, they collect premiums and they invest that money. So they have about $28 billion US that they invest. they've committed to nearly 10% of that going into green bonds. So if you're not familiar with green bonds, it is a bond or a debt instrument issued just for a particular purpose, and that purpose must be positive for climate change. So it could be solar farms, it could be electrifying a city's transportation network, could be building a green building, but it's raising money purely for that purpose. So entry point, $9.52 a couple of years ago, obviously good return on that. And what we've liked about that, what Hamish focused on was in a low interest rate environment when they had $28 billion invested, they weren't getting much, a great return on that. But with, bond prices, bond markets having completely repriced, now there's a lot of income kicking off the investments they have. So on a sort of forward PE basis, 10 when the Australian market is currently on 15 PE, it's looking reasonable value in the year ahead with a reasonable yield. Sorry, going backwards again. Scales, I mentioned, we'll talk about one that hasn't gone great for the portfolio. Scales are probably best known for their horticulture division, which is growing apples, also very strong pet food and logistics. What we like about them is they have a really strong sustainability focus, and we've spoken to their management over sort of the last year and a half, 2 years, and really engaging with us around how they think about sustainability, how they think about health and safety for their workforce, and obviously their growing food, which is a big positive. Our average entry point around 450. Whoops. Currently trading at just over $3, so it hasn't been a great returner. But the interesting thing on why we continue holding it is firstly the growth in proteins, which is the pet food division, but also, and I'll show you a slide shortly on how we look at the individual parts of the business. We think the horticultural part is completely undervalued at the moment. And essentially what happened with the horticulture, if you think of firstly COVID, made it very hard to get workers to harvest the fruit. And then more recently, catastrophic weather in Hawke's Bay has been disastrous for their crop and the land they're growing on. So, reasonably cheap at the moment on a forward PE of 12 and gross yield of 7%. The next slide, which again I've borrowed from Forsyth Barr, where I've got the blue vertical arrow, you'll see in there a really thin sliver of dark blue. That's the EBITDA, or the earnings before tax, interest and amortization, essentially for the horticultural division. And you'll see in other years, the dark blue has been quite a significant contributor to the earnings. So essentially on current pricing, there is no EBITDA from the horticultural division, which we think is going to significantly increase over the next few years, which will drive the share price. So essentially investing on it at the moment, it's undemanding in terms of current pricing, with this essential option on the horticultural part. Okay, just going back to the portfolio as a whole. So that's looking at 3 of the stocks. Going back to the portfolio as a whole, when you think about being an investor, it's not just about buying and selling shares. You've got other moving components in a portfolio as well that can have a massive impact on your portfolio returns. One of them is cash. So some funds will track the market, be 100% to the market at all times, and make no tilt away from market exposure. We're an active manager. We have a large discretion to move to cash. And like at the moment, we're about 12% cash. That can have a big impact on both our volatility and our returns as an investor. So obviously, when markets are trending down, you want to be in cash, and then the hard decision is when do you move back into markets again. Currency hedging, with our Trans-Tasman fund, we just go for the best ideas, and they may be in Australia, they may be in New Zealand. So we're kind of agnostic to the geographic split, but in terms of currency, we will then use hedging to give us a roughly 50-50 split in the portfolio. And we could deviate a little bit from that, but we typically are around 50%. Just going to show you the cash holdings, and this is basically through the 2020 calendar year. So the dark color at the bottom is the cash holding in the portfolio. And you'll see very early in the year, we started moving out of the market into cash. I think we recognized pretty early that COVID was going to be an international event. And we had probably close to 20% of the portfolio in cash by March that year. And that, obviously we didn't get hit by a lot of the market downside, and then started moving back in through 2020, moving back into markets again. So with a smaller portfolio, it's compared to just buying an index and buying the market. If you've only got 20 stocks, you are going to have a lot of volatility, a lot of tracking error against the portfolio. Our target tracking error is 3 to 6%. So that's high. That's a high tracking area, but that is the function of being an active manager with a longer term view and only holding a small part of the market. So the benchmark we use is a composite of NZX 50 and ASX 200. So 250 stocks in the portfolio. We're currently holding about 24. There will be high volatility. Some people ask us, why do you not just choose a different index so you don't have that volatility? The reason for that is our investors, which are wholesale investors, they expect us to benchmark ourselves to the same index that everyone else in the market is using. So they can explain, they want us to be able to explain how our performance relates in relation to the market, and then they can understand it in relation to comparable funds. So here's our ethical Trans-Tasman fund since inception. And the reason I'm showing you the 1 month for 1 year and since inception numbers, the 1 month numbers are interesting because the market went, or the benchmark went up and we actually went down marginally. So that shows we can differ directionally to the market. The 1 year numbers are interesting because that, we're underperforming over the 1 year, but within our target variance of the market. But the since inception numbers going back to 2019, Hamish has absolutely smashed it with about 4% per annum average over that period of outperformance, which is why when you're going to equity funds, you're not just looking at 1 month or 6 months, you're looking at longer term performance. I will mention quickly that it's easy to make a decision to buy a stock. It's really hard to make a decision to sell a stock. You've got to be really disciplined around your sales decisions. And essentially, you've got to constantly ask yourself, has something changed? And it may be in the macro environment, the whole market's got repriced. It may be something at a macro level, there may be geopolitical conflict or something that's going to impact your particular stock, or it may be company specific. It may be a governance issue. It may be a change of management. You've got to constantly question yourself, why do you hold a stock? One way we think about it is, would I buy that stock today? And if you say, no, I would not buy that stock today, then should you sell it? If you wouldn't actually buy it, then you think it's fully priced in the market. Maybe you should be thinking about exiting. But again, constantly challenge yourselves with your portfolios around not just buying, but also the time to sell. Rebalancing, so it's not just a set and forget. You've got to think about your winners in the portfolio, like the infratils. As their stock price goes up, they become a larger and larger piece of the portfolio. You have to sell that over time to bring them back to your benchmark or your target weighting. For us, we have a hard limit that no holding can be more than 5% of the benchmark holding. And we also on the downside have a rule that if there is, we're constantly looking at the stocks, but if a stock falls by 15%, you have to have a formal review of why you continue to hold that and has the investment thesis changed. In terms of testing the portfolio, there's a bunch of things we think about with testing. A couple that we really focus on. One is liquidity. You don't want to end up in a whole bunch of really small cap stocks that you can't get out of. Still small cap stocks are exciting, but at the same time, you may not be able to get out of your position in a hurry. So look at how many days would it take me to liquidate a portfolio, and also stress testing. We use really sophisticated software that we can choose basically any financial or economic event and find out what that would have done to our portfolio. We could say Lehman Brothers has just collapsed. The way the market behaved with the collapse of Lehman Brothers, what would that do to our portfolio now? Or the price of oil has gone up 10%. What does that typically mean for the portfolios? Or a conflict has broken out somewhere in the world. What does that mean for portfolios? And it doesn't give you, stress testing doesn't give you a hard data point on how your portfolio, how it's going to behave, because what an event in the future is always going to be different to an event in the past, but it will give you intuitively a sense of, am I overexposed to the financial sector? Am I overexposed to export stocks? It will give you an intuitive sense of where weaknesses may be in your portfolio. That's a look at the Trans-Tasman Fund. Want to cover off private assets. We're going to be investing, both in New Zealand and around the world. You're going to see a lot more investment in private assets, which are unlisted assets. So they're not listed on the stock exchange, which means they're illiquid. You can't sell them tomorrow. You can't find a buyer for them tomorrow. You probably can't even work out easily work out what a price or value is for them. So when you buy a private asset, you need to know what your exit strategy is. You need to, if you're going into a company, venture capital investment, you need to know what is my plan for this company? How long do I intend to hold it for? Who is the likely buyer for it down the track? And you need to be really aware of where you sit as an investor in the life cycle of unlisted companies. So this is a really simplistic look at the continuum of companies from early stage, which is, people call angel or seed. It may just be an idea and some smart people who want to bring it to life. Or it may be they have just developed a prototype product or a product they want to take to market, but very little revenue at that stage. Then the venture capital stage, the growth stage, is you have revenue, you've got reoccurring revenue, you've proven the commercial concept. You need to scale it up. You need to get into export markets. You need to really grow the company. And then later stage private equity, typically you've got stable cash flows. You've got a reliable business. Private equity investors are interested in, is it a lazy balance sheet that I can borrow some money and grow it, or can I merge a couple of companies together at this stage and make a better company? With private assets, from an investor perspective, you need to be really aware of where you want to be on that scale, how much risk you want to take, and where your skills are. And from the company perspective, like many of you will work in companies, you may work in startups, and you're looking for capital. As a company, you need to think about who's the right investor for you. Not all money is the same when you're a startup business or when you're an early stage business. What you're looking for as well is people who bring money into business, but also bring skills, who bring expertise, technical expertise, who bring networks and global markets, or have experience in growing businesses. So, if you're in a startup or an early stage business, just be really aware that the people you take money from, you want to be looking for more than just their bank balance. You want to be looking for skills that they can bring to the business as well. So in terms of investment team capability, obviously slightly different skill set needed in the private markets to what's needed in the listed equity markets. The first thing is you need people in your team as an investor in venture capital or private equity. You need people in your team that can bring a deal flow. You need to be looking at tens or hundreds of opportunities to see what's out there and sift through them. And you may look at 200 or 300 deals, but you may decide there's only 50 to 100 of those that are really interesting for you. You may do intense due diligence on 20 or 30 of those. You may invest in 10 of them, but you need to look at a lot of companies to find the ones that are within your mandate and really investable for you. You need someone in your team who can do the due diligence, so can analyze the companies, know the right questions to ask. Data is harder to get on early stage companies. And how do you value these? If they have no cash flow, how do you value a business? We were a reasonably early stage investor in Sharesies. There was no metric we could value the company on, but what we knew was they were young, smart. They had seen something that other people in the market hadn't seen. They had a disruptive product and platform, and it would scale up. They now have 500,000 customers, but in an early stage, there was no conventional metric you could use to value the business. In terms of private assets, how do you think about a risk return? In the return space with private assets, you should be thinking, I want to generate outsized returns. I want to be paid more than I can get in listed markets, because in a listed market, I can sell the stock tomorrow. In the private market, I can't. So when our KiwiSaver invests in private companies, we want to capture what's called the liquidity premium. So we want to be paid more for locking our money up and not being able to get it back for what may be years. In terms of risk, early stage companies are obviously risky. There can be failures. There'll be some that absolutely shoot the lights out. You've got to think about risk and diversification. You've got to think about how many companies do you need in your portfolio to manage that risk, the risk of failure. Plenty of good examples globally of sophisticated investors who are investing in private equity and private assets. New Zealand Super Fund, just looking at their website, they've got over 20% of the New Zealand Super Fund invested in private assets. If you think about the New Zealand Super Fund, long-term time horizon, and that's why private assets works really well for them. They're a patient investor, they can capture those high returns over time. In the UK, the pension funds there have just signed what's called the Mansion House Accord, where the large pension providers have agreed that by 2030, 5% of pension funds in the UK, 5% of the money they manage will be invested in private assets. So we should be doing the same with KiwiSaver in New Zealand. I think you'll find more KiwiSaver managers over time invest in private assets, particularly for growth investors in KiwiSaver. You know, if you're 30 years old and you don't need your money because you bought your first home, you've got 35 years till you can capture, you know, you can get your money out of your KiwiSaver. And private assets is a perfect asset to sit in your KiwiSaver because of the long time horizon. From an ethical investor, private markets are really, really interesting, or private companies are really interesting for two reasons. One is that the companies tend to be smaller, really targeted companies. You can find really purpose-driven companies that are not just there to make money, they're actually there on a mission to achieve something. You think of Sharesies, that was about democratization of finance. And I'll take you through a couple of other examples, but they're not diversified companies, they're really targeted, often on a social or environmental issue. And secondly, in primary markets, the difference between primary and secondary markets as an ethical investor is in secondary markets, so companies listed on the stock exchange, if I buy shares in Infratil, I don't give the company money. I don't give Infratil any money. The shares already exist. I buy them off someone else. So I'm giving the money to someone else. If I buy shares in Scales, Scales doesn't get any money. They've already got the money. I give the money to someone else to buy the shares. That's a secondary market transaction. They're traded on the stock exchange. Primary markets is when the company gets the money. So you think of venture capital, you think of early stage companies, they want us to invest in them. We give them the money that allows them to build their business and grow their business. Without the money from investors, that would not happen. They would not be able to grow their business. They would not get the capital. So as an ethical investor, you're having a lot more impact investing in private companies because you're helping that company grow. I'm just going to give you a couple of examples. Firstly, on the debt side, so companies that have issued debt securities, we talk about intentional, additional, and measurable. So impact investing is, I intend to invest in a way that has a positive outcome. It's additional in that if I did not make that investment, that outcome would not happen. And thirdly, it's measurable. I can measure the positive benefit that that investment I've made has created. So Women's Livelihood Bond is microfinance in Southeast Asia, giving hundreds of thousands of women small loans to help them set up a business. The social impact is financial security for their family, and typically means the children can go to school and don't have to work. So massive social benefit. If we hadn't, they were struggling to raise capital, and they've raised they've issued bonds, so they've raised debt. They've raised money from around the world. You know, we were I think the first New Zealand investor, but if we hadn't made that investment, a bunch of microfinance would not have happened. Secondly, community finance is social housing in New Zealand. So, you know, we have 27,000 people in New Zealand on emergency waiting lists for housing, and community finance is building houses to take those people off the emergency waiting list and provide them warm, dry housing. They need the funding to do that. So our KiwiSaver has invested in 3 of their transactions. On the equity side, sort of early stage equity, Lodestone Energy, you don't think of New Zealand as a place where solar is going to work, but there are, you know, think of the top of the North Island and East Cape, plenty of good sites for solar. Lodestone Energy has raised 150 million of equity in New Zealand and 150 million of debt. They're building 5 solar farms. Their first will come on stream in November. So we've invested in them at an early stage to enable them to develop the solar farms. Really, really high quality management that have done this in the US. So we had a high confidence that this would succeed. But again, they needed the capital from people like our KiwiSaver to make this happen and bring that impact. Waleed, really cool story, young guy in Tekapo. What he was seeing is every Band-Aid in the world is plastic and ends up in either our ocean or landfill. He's developed the world's first biodegradable merino wool Band-Aid. and he had a great product, revenue in New Zealand. He wanted to take it into the US. We gave him the capital to do that. So again, when I talk about additional, he would not have got into the US markets had we not given him the capital to do that. And again, you can look at companies like WillAid, and you can measure the benefit in terms of every Band-Aid that is sold by WillAid is a piece of plastic that doesn't go into landfill or the ocean. It's a very measurable impact. Two other companies, Mint Innovation. So we don't invest in mining companies, but we need to provide a solution for, for the world needs commodities, right? The world needs the building blocks for making things, for making electronics. Mint Innovation is a New Zealand company that's developed technology for using chemicals and bacteria to extract metals and commodities from e-waste. So it's called urban mining. Laptops, TVs, any types of electronics, they can extract up to 20 metals from the e-waste. They've got a small plant in Auckland. They've commissioned a large plant in Sydney. We've helped fund them to start their plant in the UK. Groove is a mental health app. Companies can subscribe for their staff. We looked at it and said, actually, this makes sense standalone as a business in New Zealand. We'll invest in it alongside ACC to help it take the product global. So private assets, I think, are going to be really important. Don't just think about listed assets when you think about your KiwiSaver, or when you think about where your career should go. The private asset space is really exciting. Going to share some final thoughts with you around careers and where do you want to go? You've got a lot of opportunity in finance generally. Some really cool opportunity out there. ESG analysts, every fund manager is building its ESG capability. Sustainable finance, the banks are very focused on green finance, on green bonds, on sustainability linked bonds. Sustainability within corporates. Corporates are hiring teams around sustainability to reduce their carbon footprint, reduce their water use, reduce their waste that goes to landfill. On the advisory side, the large accounting firms have quite large consulting teams that help large corporates around their carbon footprint, around their measurement. And then reporting, if you love financial reporting, then you'll also love carbon reporting, which is coming. So new carbon standards coming into New Zealand. 200 plus fund managers and companies to start with will have to report their carbon footprint. So think of it as, carbon reporting in the same way you do financial reporting. And then impact, we're talking about before about private assets and how you measure the impact of private assets. Global standards are currently being worked on for impact investing to measure the additionality and impact of that. So how do you approach a company? What do you do when you see a job advertised? Just some hopefully helpful tips. Firstly, be really engaging and succinct when you're approaching a company. Sometimes I get emails from people who want a job. They might write seems like 5-10 paragraph cover email, and then they've got a 7-page CV. Sorry, but I just don't have time to read that. Just do a really short, succinct, interesting cover email, have a really short, really punchy CV, have some graphics, have some color. When we advertise the job, we literally can get hundreds of CVs. Some of them stand out because someone's just done something really cool with their graphics, which is really simple, but you've got to stand out because you want to be engaging with the people that are looking at potentially hiring you. Secondly, personalize your approach. People who send me an email saying, "Dear HR manager," very unlikely to get a job with us. Would have taken them 2 seconds to look on our website and see what my name was. So be personal when it's much more engaging for a company to have a personal approach. Really important to know yourself. I don't know if you've heard of Mind Lab, which is run by Frances Valentine. So it does postgrad, really interesting postgrad courses around change in society and change in business. And she's saying essentially for young people coming through, for students and for my kids, there are 2 skills that people need. One of them is emotional intelligence, is for what do you bring to businesses in the future. Part of that is about self-awareness, is understanding who you are. So when I traveled and ended up in the UK at a job interview I had, they asked me as a lawyer, so I was a lawyer at the time, as a lawyer, are you what do you enjoy? Do you like being in the office drafting stuff, or do you like being at the table and negotiating deals? And I said, yeah, I kind of enjoy both, and which was a really bad answer and probably cost me the job, because what they were really looking for is saying, yeah, I enjoy both, but my skills are, I am really good at the detail, really good at the documentation, really good at the complexity around the thinking behind it. Enjoy the negotiation, but I hate conflict. Probably not really good for me to be the frontline lawyer negotiating the deals. And that sort of self-awareness would have helped them understand who I was better. So know yourself. And finally, perseverance. You're going to need to be resilient. You're going to need to have perseverance, because you will write emails that don't get responded to. You'll make phone calls you never hear back. You will ask to meet people and they will never get back to you. Don't take it personally. You've just got to throw yourself out there and be resilient, because generally, I try, if people approach me and say, I'm trying to work out my career, I'll try and give people half an hour, but sometimes it's really hard, right? So don't take it personally if you approach people and they can't give you time or don't come back to you. There is actually a blog we've got on our website if you're interested, just on tips for thinking about getting a job in finance. When it comes to the interview, firstly, be really prepared. Understand the business, do lots of reading, trawl all over the website, and you need to understand the business that you're approaching. So our business is different to a passive manager. If you don't understand the difference, it will be really obvious really quickly, and you won't stand out as a candidate. Secondly, you've got to connect with people. So if you're going for a job interview, ask who you are likely to be interviewed by. It's not a rude question to ask. It's not a secret. And then, without stalking, check them out on LinkedIn, Google them, find out a bit of them. If like Hamish was interviewing you and he's our our Trans-Tasman equity manager, you can make a comment about his fund and say, see your long-term returns been great. Do you put that down to your stock selection? That builds a connection or rapport for you with an interview with the people. And questions, prepare yourself to ask some questions that are really insightful, and I'll just show you a couple of slides on how to think about that, but also be ready for questions that we are likely to ask you. Too many people come into interviews are underprepared or completely not prepared, like the question of, why would you like to work at Pathfinder? And the answer I had recently was, I saw the ad and I don't know, I just saw the ad. And like, you're not going to get a job at Pathfinder if you can't relate to who we are and the type of investing we do. Here's a slide of our KiwiSaver funds. I'm sort of very cunningly trying not to advertise to you, but so I'm just bringing this into the conversation around something. When you see this on our website, of our returns from our KiwiSaver across conservative balance and growth completely outperform the industry average. Your question to us could be, do you do that through active investment, or do you do that because you're an ethical investor, or is it both? That would be a really smart question to ask. When you look at our website, you'll see our vision as a business is to help fund a lasting transformation to a better world. You could ask, what does a better world look like? How long is that transformation going to take? Just be aware of what we're likely to ask you. When you see that our investment focus is ethical investing, the question I'm likely to ask you is, we have a lot of, which I ask everyone I interview, is we have a lot of challenges in our world. For example, climate change that is impacting businesses, that is impacting communities. As an individual, what are you concerned about? What do you worry about for your future and for the future of our communities? People who then say to me, I've never thought about it, probably aren't going to be a good cultural fit with us, but clearly haven't really thought about and prepared themselves for the interview either. So I just encourage you, you've got to stand out in the interview. You've got to do your research in advance. Sort of the most important question, the most simple question, when you think about where we are and we're interviewing people, we're all going to sit around, we're going to say, I liked that person because. What is that because going to be? Like, what is the reason you want us to hire you? You've got to be really clear about that. And the flip side is, we're going to ask you, why do you want to work at Pathfinder? We'll either ask it directly, or us or any other job you go for may not ask it directly, but they'll be trying to work it out through your motivation. If you don't have it clear in your head why you want to work in that firm, you're very unlikely to get a job there, because someone else who knows why they want to work there will do a better job than you of selling yourself. Learning and your knowledge is super important, but it's not, your grades alone are not going to get you the job. It goes back to what Francis Valentine was saying. It's about EQ. It's about the emotional connection. So that's it. Time for questions or thoughts. We've got about a quarter of an hour left. So, oh, it's 5 minutes. Oh, okay. It's as a we're a long only manager, I suppose. From a we've done a lot of debate around the ethics of using derivatives and shorting tobacco stocks, for example. But we've just decided from a risk and portfolio management position, we just want to be long only. And if you think about the difference between going long and short, if you buy a stock and you pay $5 for the stock, what is the most you can lose? $5. It can go to zero. If you pay $5 for a stock and you short it, what is the most you can lose? You don't know. The stock could double, the stock could triple, and your losses just continually mount. So it's harder, and it's, to be honest, it's a different skill set as well, shorting to going long. So we don't short in any of our portfolios. That's a really good question, actually. So the private assets, like we have a short data history of private assets. Our KiwiSaver started in 2019, so we've got 4 years of data. Our first investment was in Sharesies. It's been a massive outsize investment, but it's a short time horizon, right? It's the data period for that's too short. But if you look at private equity investors, venture capital investors, typically they will be targeting long-term returns of 15 to 25% across their portfolio. But you're talking about a 10-year time horizon. But yes, you need to capture the outperformance because you're illiquid and you're holding those for the long term. Yeah, that's a really good question. So with obviously with listed companies, we just get a data feed, constant data feed of the current pricing, and you can work out your portfolio value. The unlisted companies, there is no transparency around the pricing. So we have to build our own pricing models, and we get those audited every year. It could be a discounted cash flow model. It could be a really good indicator of value is if other shareholders come in, what are they prepared to pay? That gives you a pretty good calibration on whether your valuation model is working or not. You can use your entry price and modify it for comparable listed stocks and how they're behaving. There's a number of different models you can use, but it's kind of on a company by company basis what makes sense. But that takes a lot of time, as opposed to just getting a data feed of a listed stock. Valuing a private company takes a lot of time and energy. And again, if you think of KiwiSaver and putting private assets in KiwiSaver, so we can put up to 12%. We've probably got 6% of our portfolio at the moment in private assets. We can put up to 12%. We've got to get the pricing right because people are coming into our KiwiSaver. We don't want them overpaying for the value of the assets. People are leaving our KiwiSaver. We want them being paid fair value on their exit. So getting the valuation is absolutely right. Is really important. Thanks.
Kind of a follow-on question from that around the liquidity and pricing issue. When you think of Infratil, a lot of what they do is kind of like a private investment fund in a way, right? They invest in One New Zealand and other things, and I think they have some direct projects as well. So do you think investing in these sort of private equity funds can solve, if they are listed themselves, like Infratil, can solve these issues?
It certainly makes it easier. So there's an unlisted venture fund in New Zealand called Punakaiki Fund, and that is invested in New Zealand technology companies. They plan to list on the stock exchange within the next year or two, And that will be fantastic because that will give you exposure to venture capital, really cool New Zealand companies, growth companies, and you'll get a daily price through the through it being listed. So yeah, that does we struggle with that at the moment in New Zealand, but that does that will open things up and make it way easier for investors to get access to the asset class.
Maybe time for one or two last questions if anyone's got one. All the students will be sending, well, there's a group of students that have signed up to send you a follow-up, so I'll collate those and send those through. You can decide who to respond to or not. Maybe one last question that's a little bit cheeky. When you say that's a $1.8 billion fund, Pathfinder and Alvarium, I'm just curious how much is Pathfinder, the ethical fund, and how much is Alvarium, which I guess is a more traditional investor?
Yeah, Alvarium is essentially looked after family offices around the world, which are ultra wealthy families. So when we took them on as a shareholder, their core client base was 300 families with $30 billion. So do the maths on that, pretty wealthy families. What we were after was capital to launch our KiwiSaver and a shareholder who aligned with our value set. And what they were after was they managed money for these incredibly wealthy families, and they were seeing the next generation coming through and saying, that's wonderful, Alvarium, you manage our money and make us great returns, but what's the social impact of your investing? What's the environmental impact? And they wanted to learn how to embed that in their investment process. So we agreed to deal with them when they'd join us, and then we went to London and helped them rethink how they invest to bring ethical investing in line. To answer your question, they look after charities, wealthy families in New Zealand. Of the 1.8 billion, Pathfinder is probably 650 million of it, and so over $1 billion in Alvarium itself.
All right, we'll leave it there. So please help me in thanking John for coming today. Thank you. See you guys next week.